Hello, everyone, and welcome to another Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us always in the chat to answer questions. We're really excited to have you guys with us here this week. Got a lot of great information to go over, and again, it's going to be great. So if this is your first time on, you'll notice that your microphones are muted. That's so we can all hear Jeff and I talk. But there is a Q&A box you'll find at the bottom of your screens, and throughout the evening, you can put questions in there, and we'll answer those periodically and also at the end before we hop off. If you have any questions about your own account with Altos Trading or Zillion, access to Trade Trend, any open trade alerts, anything like that at all, email support at Altos Trading, and we'll get to those tomorrow. If you have to hop off for any reason, this is recorded. It will be available in the members area later tonight and also tomorrow on YouTube. So before I bring on Jeff, let me just read the disclaimer here. Trading securities and options involves risk. Prior to buying and selling an option, investor must receive a copy of characteristics and risks of standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to time-critical nature of trading, broker fees, and the activity of other subscribers, there is no guarantee that subscribers will mirror our performance. And performance numbers shown are based on trades users could enter based on the trade signals. All right, with that being said, let me bring on Jeff. Jeff, if you want, grab the microphone.
Hello.
There he is.
See me? Hear me? All right.
Yeah. How you doing?
Good. Welcome, everybody. Richard's getting ready for a big move this week, so appreciate you being on and taking time out of your personal evening, I guess.
I'm telling you, man, like I'm so tired of like the sound of the tape gun and the boxes. I've got like 15 paper cuts.
Yep, got to wear gloves.
The battle, man.
Yeah, brutal. I think you've moved more than anyone I know.
I know, man. Like full blown nomad, man. Just
yeah.
every couple of years we pop around. But I think after this one we should be set for a while. Daughter will be locked into school and we'll finally be where we need to be. But she actually dropped like one of my favorite bottles of scotch and broke it this morning. So kind of mourning the loss of that today.
Oh no.
Yeah.
Have to get you a new one on your birthday.
Exactly. Yours is coming up soon, isn't it?
Yeah. Don't remind me.
I put it in my calendar because I miss it every year, and I haven't got the warning, but I know it's in July. So
it is. It's coming up.
What do you want for your birthday?
Get out of this bear market.
I think everybody else wants that too.
We kind of got out of it on the S&P, but we'll see.
Yeah, we'll see.
And they were back in it today after the close, probably, but we were there for a minute, for a day.
Yeah, we'll see.
Yeah. So anyway, so I really enjoyed the session we did last week.
Me too.
And I hopefully gave everybody some more clarity about what's happening in the medium to longer term. We're going to review a little bit what we talked about last week after we do our market overview. It'll kind of be a part of that and review the major moving averages because this is the last week of the month. And we're going to have, I think, more clarity based on the monthly close on the S&P this week. And then, it may take into July to really see the follow through, whether it's to the upside or the downside. But I think we need to be paying very close attention to the close this month, the monthly close on the S&P as it relates to the 36 period moving average or 36-month 3-year moving average. So we'll review that from last week. Did we get that the recording from last week up on our channel? I don't know if I got it from you.
I'll send it to you if I didn't already.
Okay. Yeah, we'll get that up. If it's not there, I think we may still need to get last week's up on the channel. And then, as I promised last week, once we get through our overview and mapping out our levels and talking a little bit about monthly moving averages, we're going to make this session this week mainly a ticker roundtable. So be prepared to share your favorite symbol, whatever you're currently watching or want to look at together. Just keep in mind, we can't give any personal trade advice or anything directed to, in light or in view of any particular investor's needs, including, financial advice, but happy to look at whatever you guys are watching and do kind of a group roundtable analysis of it, share some ideas and things like that. And then wrap up with Q&A. And of course, always put any questions in the Q&A or chat throughout the session if you have any. Richard will interrupt me, and Craig's also there to help out and answer those. If you have any other questions that we don't bring up. Brian says he moved 15 times in the military and 7 times since. I think that might beat your record.
Yeah.
I just moved into a motorhome and now I can move without moving. I like that. That's cool, Brian. Yeah, I've got my wife and I got a motorhome a couple of years ago and really enjoy it. So it's the move. It is the move without moving. So it's kind of nice to have.
How was it? You went to the coast, right? You said gas was pretty gnarly going.
Oh yeah, that's a yeah. I saw. It's funny. I saw this commercial a couple of weeks ago on TV from Camping World, and they're like, they're promoting these motorhome sales events and things, and they say on the commercial, like, this is the best time to buy a motorhome. It's the least it's less expensive than it's ever been. And I'm thinking to myself, like, that couldn't be further from the truth. I mean,
interest rates are up.
Yeah, for a lot of reasons. I would say mainly gas, but then interest rates and if you finance and all these things. So it's like, I saw that commercial. I'm like, what are you talking about? Yeah, we took our motorhome to the Oregon coast. Geez, almost a month ago now. But yeah, it was like gas. It's like $250 every time you fill the tank up. It's a 50-gallon tank. So pretty ridiculous. All right. So without further ado, let's get over. Already got some tickers coming in. Cool. I'm going to flip off my camera and get over to our dashboard. Let's refresh and get today's data. Let's take a quick look to it at just the overall market sentiment and sector performers. Risk is kind of ticking up a little bit as we've rotated lower. You'll notice that, and we've talked a lot about the Bollinger Bands and using those for standard deviation moves, volatility analysis, as well as trend and mean reversion. So you can see we had over the past week or so, mean reversion off a 2 standard deviation move from the lower band. This is on the S&P 500 index, up into the mean, the 20-day moving average, and we've sold off from that today. A little bit of yesterday and mostly today. But let's see. I'm going to expand this. Oops, sorry. Actually, let me go back. So I got ahead of myself. So because of the rebound that we've had over the past week or so, our algorithms have a disproportionate weighting towards buy signals. And I expect that will begin to shift this week due to the sell-off over the last couple of days. We want to really see the buy-sell ratio and the trend gauges align. And so obviously we're still in a significantly bearish trend, and the risk gauge is ticking up as well. We only have utilities is really our only positive performing sector right now. And for that, we use the XLU, the utilities ETF. And then we have some significant underperformers: consumer discretionary, technology, and materials. And then, on a broader perspective, the major indices are obviously in a longer term downtrend and remain in a red divergence cloud. So generally, when we see a security or an index trading in a red divergence cloud, our higher probability trades are going to be short positions within that cloud. So what the level that we were really watching last week into the start of this week was 3,900, or maybe more of a zone again, 3,800 to 3,900. So those are the two kind of boundaries of the century mark boundaries of the zone, which was a resistance zone that we were watching. And we broke through on Friday last week, which is now proven to be a bit of a false breakout. However, if 3,800 holds a support, we're still in that zone. So let me annotate those for you. So you'll notice that from back here around the third week of May, we had a significant upward rotation in the S&P following the sell-off in March and April. All right, and so this was a century mark, a rotation higher, almost to the positive 2 standard deviation band, and then another sell-off. We broke that support level at 3,800, traded through, came back up, and then broke through another century mark last week at 3,900. So that was looking promising, and these were significant levels. You'll see that there was a day back in June where the S&P found support there, and then gapped on the open the next day, and then traded below 3,800 and closed below. And then, of course, we found over the next couple of weeks or so some resistance at that 3,800 century mark until late last week, and then break through it. So not only do we gap through the 3,800 century mark, we and open higher, but the next trading day, but we closed above the next century mark, being 3,900. So when that happened, there's a couple things we want to take into consideration. We're mean reverting, so we're coming back into the mean, which is generally going to provide some degree of resistance. And we're in, again, a red divergence cloud. And so this tends to be where people will get kind of faked out, and why I think, if you're going to counter trend trade against the broader trend, it's really important to wait for confirmation. So we're obviously in a long-term downtrend from the start of this year on the S&P. So anytime we see a close above a century mark, like we did last week, the prudent thing to do, in my opinion, in terms of waiting for confirmation, is to wait for 2 to 3 closes above that level. And sometimes that'll mean missing out on counter trend opportunities if they move too fast, like this one from last Friday. But patience is a virtue, right? So it can still pay off if you wait for it, and it can also save you from getting whipsawed and false breakouts to the upside or the downside. It can go both directions. So kind of saw that today. What we want to watch for tomorrow and through the rest of this week is this 3,800 level, because it's actually not just the lower boundary of this support zone, but it's a strong one, because as you can see, where I've circled these days where back in May it was support, then in mid to late June we had 4-5 days of strong resistance after that support was broken, and then broke through, and then we're coming back down into that level. So that's the when we do this type of analysis, we want to look at the nearest level that we may be encountering as step one. So right now that's 3,800, because we're trading into it. So you want to look at the directional movements into a level or a zone, and that would be the directional movement right now is down, and the lower end of the support zone is 3,800. So we're in this this century support zone from 3,800 to 3,900, and 3,800 is the lower base. Now, if we close below 3,800, then our expectation is that we see a retest of the lows down around 3,650. So we'll want to watch that for this week. And conversely, if 3,800 holds as support, we'll want to continue to use this 3,800 to 3,900 zone and monitor price action off these boundaries or levels, 3,800, 3,900. So if this holds, and again, considering the nature of the market and the levels of the VIX, it's prudent to wait for confirmation. So a close at the end of trading, since we are analyzing a daily chart, to avoid any sort of fake outs. So just when volatility levels are high, when the VIX is above 20 and certainly above 25, you're more likely to see a false break of one of these levels on the S&P. And it doesn't take a lot to to turn prices around intraday, especially if you hit the outside of an average true range or a major level of support or resistance. So these are the ones that we're watching for this week closely. If we can somehow get back above 3,900 this week, which is appearing less likely, but certainly still a possibility, then as we looked out last week, we've got a bit more room to the upside to run here. And if that happens, then it's going to be more likely that these lows from around the second or third week of June will hold for a while. And that's where we're going to want to look at the close of June, the closing price on the S&P at the end of this month, which is Thursday, as it relates to a 36 period monthly average or 3-year moving average. So we'll take a look at that real quick after, because it was a topic of our session last Tuesday, after we look at the NASDAQ and the VIX. So let's go ahead and do that real quick. And we'll just use the QQQ. All right, so you see how the Qs, the NASDAQ 100 ETF, also mean reverted from a 2 standard deviation move. Looks very similar to the S&P, right? There's the move into the mean and then the rejection. The support is in the zone that we're going to look at, is a little bit more precise on the Qs and more in play right now than it is on the S&P. So one thing that we want to take note of is that this level, and I'm using it as a proxy for, if you look at the lows from a couple days back in May, and then these false break and reversals, and then the rotation up to around a positive 2 standard deviation move from the mean. That's why this level holds a lot of significance. And you'll see that as price came back down and broke that support, it retested and you saw more rejection and sell off. And then of course comes back up in, and you'll generally see, once a support level is broken, you'll see it turn into resistance. And so that's what happened here. All right. And then we broke. And now when it broke here on Friday on this candle, this level that I've mapped out, it's now support, and that broke today. But to emphasize the importance of using zones, we then want to start looking at some of these lows and highs from back in May and June. So this zone's a little bit tighter quite a bit tighter than it is on the S&P, partly because this is the Qs and they traded a much lower price per share. But you'll see here that we had quite a bit of support here and then resistance as well. So again, a zone more so than an exact level. And we closed today on the Qs kind of at mid zone there. So this is where we want to be watching tomorrow to see how price reacts around these. So the lower boundary of the zones around 282 to more precisely it's like 282.14, but we'll use 282, and with these I generally will round down when you're close to a century mark or a whole number, and then the higher end of the zones right around 285. So let's keep an eye on this for the rest of this week. A bit of a tight zone on the Qs there, but should give us some indication of direction through the remainder of this week. If we get a strong close below this 282 level, again, just like on the S&P, I'm watching for a retest of lows from back around the middle of June. If this support zone ends up holding and we get a reversal, which would be a trade lower and then a close higher outside of the zone, or at least a close within the zone, I'm watching for strong closes above this 285 level for potential a continuation of this up move that began back in mid-June. But there also, if that happens, and I think it's less likely just because there are some other strong resistance areas that we'll encounter here around 288, 287, 288. And then we've got this major one around 295 to 296. And then we've got another one, around 300. So we've got a lot of resistance on the NASDAQ. And again, like with the S&P, we're in a red divergence. So, sentiment is negative, and trend is down. So for our higher probability opportunities, we want to be looking for short setups, right? And there was a nice one here back in earlier June. Okay, so then let's take a look at the VIX real quick. So interestingly, we've really paid attention to, I'm gonna actually take this Bollinger Bands off the VIX. We've been really paying a lot of attention to this, let me zoom out, 24 to 26 support zone over the past weeks, and emphasizing how important it is to really watch this, because the VIX has remained elevated for most of this year. We really only 20 has been really our support, and we've spent very little time this year below 20. So volatility remains high. Good news is, if we're looking for counter trend trades or short-term rebounds, we've had very reliable indicators of that around the 35 to 39 resistance zone. So typically when we see the VIX spike up into that level and then retreat, we get some degree of a rebound in the market. And it's done a great job of giving us some degree of advanced notice before the S&P actually makes a move up. And then right now, we've got 24 is kind of the base of our support zone, and 26 certainly, and maybe even 28. All right. So when we see the VIX start to reject, these are currently, because whenever the VIX is above these levels and retreating into them, their support. So as we're watching, the VIX retreating these levels, we want to see, are they holding, and is the VIX moving up and closing back above, which it did today, right? So we're back above. this 28 level, which is kind of our base. There was some resistance to consider here from May of last year. So around the same time of year, May, a little bit earlier in the year last year, and then into September. We tend to see volatility start to decrease in the summer months. Things tend to kind of smooth out a little bit. But we're in a bit of a unique year here, so I don't want to, assume that or count on it. But the more immediate level to watch for like tomorrow on the VIX is 29 as resistance because of these rejections from last year off that level. And then we'll keep an eye on this support zone that I've highlighted here. When we see the VIX close and start moving off the 24 level to the downside, that's when we'll likely see more of a sustained rebound in the market. But the good news is that the VIX is really our friend, and what we want to do is keep in touch with our friend, talk to him on a regular basis, ask him what he's telling, what he's doing, what does he want to tell us, and that would be that if the VIX closes back below 20 and can stay there for more than it did here, because we just got basically a lot of sideways chop, wide ranges in the VIX, right? So that tells us that intraday volatility is high, and then a quick move back up. So if you look at the line in the sand here at the beginning of this year, right? So market right there, start of 2022, we before the market turned over and we sold off into bear market territory, we started below the 20 level, but not for long, right? We got up there and we've spent the majority of the time above 20. So when we're in bear market conditions or sustained downturns in the market, and we're getting sustained VIX readings above 20 and especially above 25, that can actually help us, when things finally turn around. And again, to reiterate, that's where the VIX, becomes our friend. And when he tells us that, he's going to stay below 20 for an extended period of time for more than a week or two, and then start using that 20 level as resistance instead of support, then we can actually start considering pulling out of the bear market and more of a sustained rebound. But until then, any long position is really a counter trend position at this point. All right, so let me clear these out. I'll pause it real quick and see if any questions have come through. Then we'll take a look at the 36 period moving average on the S&P that we talked about a lot last week, and just want to reemphasize the importance of watching that through Thursday of this week to see what happens. And then just because we're starting to get a bit of a rotation lower on the S&P, we may really have to use the month of July as well to see for more confirmation to see what happens around that 36-month moving average. But any questions, Richard, on the levels on the major indices or the VIX?
With the VIX, it's looking like, I don't know if you take this into consideration, but it seems like the ranges, like kind of starting from early 22, they were below 20, around 15, 16, and they shot up to 35 to 39. And then it seems like as the year has progressed, it seems like there's kind of like almost like higher lows for the most part going through. And it's like the range that it's going from low to high, and the high is, like you said, between 35 and 39, seems to get smaller and smaller. Is that?
Yeah, so we do have kind of like and that's typically what you're going to see in a bear market. And so you're going to see kind of this upward sloping trend. And then, it ends up kind of being a wedge. So as time goes on and price keeps moving, we may see the VIX kind of wedge into tighter ranges until it finally really, the markets can bottom and there's enough buyers coming in to drive prices back up and reduce volatility. So we definitely, want to keep an eye on that. But yeah, exactly. We're making, higher lows, just because the VIX is, volatility doesn't stay elevated forever. So it tends to retreat. So I don't, necessarily look at whether we're getting higher highs every time, because it's not like an index that will trend that way. But certainly when you're getting higher lows on the VIX, it tells us that there's more bearish sentiment, and that's typically what you'll see in an actual bear market.
Okay, that's, yeah, it just kind of stuck out to me. I wondered if you noticed that wedge as well, and if it made any idea as far as like an end to it, or more of a, catalyst for worse conditions or what. Anyways,
Yeah.
thought I'd
All
ask
right.
that. I got another kind of question. I guess it leads into the Q&A. Do you ever look at 10-year bond interest rates as far as looking at how that impacts the market as well?
I don't really follow bond rates all that much, as they relate to, the major indices or the markets, broader markets. I know a lot of people do, but I find that I don't really need to, consider bond rates as it relates to the way that, that I analyze the markets and trade. And for me, kind of, they tend to have more of a lagging component in terms of, I guess they don't really give me the forward-looking information that I get just by analyzing the VIX. So I don't watch bonds real closely. But generally, obviously when you see, rates in general being raised, and I think the next rate hike is slated for mid-July, maybe. I'll have to look that up. But that's really what's going to, indicate, rates in general, the impact on the market. I've never invested in bonds. Interestingly, they're attracting more investors right now, and likely out of fear of, equity, what's happening in the equities markets. But yeah, if there's something specific, I'm just looking to see. Oh, it's Michael. There's something specific, Michael, that you want to, cover on those. Certainly be happy to do that. But it's not something that I really take, use in my trading decisions or analysis. But in terms of like rates in general, I think that in the context of the level of inflation that we've reached, and what's required to bring that back down into reasonable levels, and the length of time that we were in such low interest rate market conditions, those are things that tell me that the bear market will likely be a relatively long sustained bear market. So I wouldn't be surprised, if we were in bear market conditions for 2 to 3 years even. And a lot of that's going to be dictated by the aggressiveness of the Fed, and then where that trickles down is that we have to start seeing how it affects like gas prices, and really on a corporate level, like quarterly earnings. So if we can kind of stabilize the inflation, which is starting to happen, and then get back down into more reasonable levels, without getting rates too high, then come out of that with the next outcome being that quarterly earnings don't get hit too hard across the board, especially with your big blue chips, Microsoft, and a lot of these, I think Microsoft makes up like 4% of the S&P, but these companies that make up high percentages of the major indices will want to watch their quarterly earnings and see, how they're doing after the dust settles, because I think that's going to really indicate, on a fundamental level where things turn around for the markets, and whether we get out of this situation sooner rather than later. So when we're looking at fundamentals and rates and things like that, and then you can look at bond flows, like if you start seeing inflows or outflows of bonds, sometimes that can give you a little bit of a leading indicator of, because generally that's going to move back and forth between equities and the equity markets and in the bond market. And so when you see those start to you can look at bond flows and kind of get an indicator of where money's moving. It's not a sure thing. You don't know for certain the flow of the money, but you might be able to get a bit of a gauge on that as you analyze the rates between bonds and price action and equities in the major indices, and which kind of direction the money's flowing there. So yeah, Michael, if there's ever anything kind of specific with those that maybe you watch or you want to dig into a little deeper, be happy to look at that.
Let's see. While you're still on the VIX, Ed was curious, and you covered this in the past. Just wanted to know, how far do you typically go out when you're trading on the VIX?
Good question, Ed. So depends on your on what strategy you're using. Like we talked in past sessions about ratio back spreads on the VIX, which I think are a great VIX strategy. But certainly a lot of people just buy directional call options on a VIX spike. So it kind of depends on market conditions, the strategy that you're incorporating, whether it's a ratio back spread or just buying calls, or a vertical spread, two-legged spread.
I think he's just saying like just buying it up, buying it up,
just like buying a call.
Yeah.
Option. So I think the more volatility there is in a market, or when we're in bear markets, at least 30 days, but and also kind of look at what the VIX is doing. How frequently is it spiking? Right now it's spiking a lot. And so the more you see it spike, the shorter period of time you may be able to go out. And of course, you can always roll options out to further expirations. But generally, with securities that have weekly options, the VIX is a little different. So you'll see things like backwardation, where you'll see longer dated expiration premium priced lower than shorter dated. And so if you're an option buyer, you'll often see, if you just go out to the nearest weekly expiration, you may see higher premiums. And so if volatility stays elevated and you keep buying weekly options, you'll end up paying a lot more if you just go further out in expiration. But it kind of depends on the volatility levels at the time. So for me, it's more important to analyze when it makes sense to buy VIX calls, and that would be when we're near a support level, and particularly when we're below 20. It's usually when you're below a the line in the sand, for me 20, that you're inevitably going to get some degree of a VIX spike over the next quarter. So if we're below 20, I may go out a few months. If we're basing around like 25, and that's ends up holding, like this could have been an example back here. So see how we consolidated in the early part of June around the 25 support level that we had mapped out, and then we spiked up and closed above it. We actually got a buy signal that very day from Trade Trend, and then see the follow through on June 10th. That would be an example of a support holding, a rotation off of that support level, and a potential opportunity, to buy short dated calls. So in these types of circumstances, then I might go out, only 30 days, because VIX spikes can happen very quickly. But again, because the nearer dated expirations tend to be, you get that sort of backwardation where the pricing, there's volatility skew and the pricing is higher due to extra gamma risk. Then sometimes you're actually better off buying a further out call option if you're just buying directional calls on the VIX, and then it gives you more time. You may not get as dramatic of a return or ROI on the call premium on a longer dated option, but these can still pay off fairly well. And I actually prefer ratio back spreads on the VIX when I'm playing it directional moves like that, or if I'm using it for like hedging for portfolio protection. Might kind of go to as a ratio back spread. And again, we've done a full session on those, posted in our channel if you didn't attend that one. So kind of go through how to structure those and when they make sense and how to choose your expirations and things. But I think, when you get into lower levels on the VIX, definitely below 20, but even if we're basing around 20, it's good to give them, like, look at the last time we were actually down at 20, which was April. All right, so here was the last time we were actually down at 20 on the VIX. It took a while, right? It took, not only was there some consolidation here with because the first consolidation around the VIX was late March, early April, up into the 25 resistance and then back down. But even though this happened, within most of April and then spiked kind of early May, it almost took a full month. So again, that's why I say at least 30 days to really take advantage of the full spike. But even going out a quarter, if you want to just kind of manage it less and the premiums, aren't too high going further out, as an option buyer, generally better to give yourself more time. But that's why I like ratio back spreads, because you can finance the long strikes by selling strikes at a ratio, generally use a ratio of 2 to 1 on those. So yeah, good question there.
All
right, so let's I want to leave some time for a ticker roundtable. I just want to take a look real quick because we looked, I don't have the monthly up still, at the 36 months. So just kind of to follow up from last week on the let's see, let's go into studies, 36 period moving average. So it's something that's very closely watched among institutions, hedge funds, and money managers, is the 36 period simple moving average on the monthly chart. So we're looking at a 3-year simple moving average. And I went over the reason behind that last week. But we often, as you can see when we do, see sell-offs in the market, we tend to see a lot of support and rebounds from that level. And it's happened within the month. So this is this candle here at the very right of the chart is the month of June. So this encompasses all of the month of trading on the S&P 500 index SPX for the month of June. And you'll see that we traded down into 36 and change. And then you'll notice that buyers came in there and pushed the price higher. You'll notice that we're at strong support. See, it gets so much clearer to look at support and resistance on higher time frame charts. All you have to do is look at the entire month of May and look where we are right now as we approach the end of the month. We're right near this support level from the lows in May. So see how much easier that is to see. But what we want to watch in terms of this 36 period moving average is how price reacts around it over, through the rest of this week into the close of the month, and then certainly into July and potentially further, depending on what happens. So this is, if this 36 period moving average can hold, it may be a potential buying opportunity. Maybe it could be near term, could be medium or even longer term. But if we see close below the 36 period moving average on the S&P, then we want to wait for a subsequent close back above that to give us, direction in terms of, in combination with looking at the VIX and everything else that we do, for confirmation that we may get an end of the bear market conditions and a rebound or even a bull run, like we did here. So this was the last dip below. That was the COVID crash back in February, March of 2020. That was the close below, and then next month close above. So that's what we'd be looking for if we do get a close below. You'll see that we have something kind of similar here. Actually, look at this candle from back at the end of 2018. This is December, the December candle. See how similar it looks to this one for June this month? Right now, we need to wait to see how it closes, on Thursday. But look what happens here. So the next month, right, January of 2019, this is where we've been looking for confirmation because we dip below. Then we want to see a strong close above. If we only dip below, we want to see a strong close above. If we close below, we don't need to see, the entire candle like it was in this case, the range of almost the whole candle trading above the average. But we want to see a strong close, bullish close, meaning price closes near, bullish, higher than the open from the start of the month and near the high of the range. Okay, so you see how that happened in both these cases, and then we get big moves. This one didn't last as long, right? Obviously, that was a good bull run in 2019 that was derailed by COVID, and that's what created this second opportunity before we got a really serious bull run that ultimately, ended and led us to another mean reversion to a 36-month moving average. So I'll kind of leave it at that, but we'll continue to follow this just because it's so important. But keep an eye on this because these can creep by in opportunities, but they need to be, treated, analyzed correctly and treated appropriately. We actually, want to really see what happens on a closing basis at the end of the month. And then it's typically going to take some patience and waiting to see what happens on a closing basis the next month. And it won't even, won't necessarily even be the very next month. We may have to wait longer, but we'll see. But we're starting to get near, we've mean reverted to the 36-month moving average, and we're starting to get near some very critical levels to analyze, and then, use in our decision-making process and, ideally provide more clarity on market direction, medium to long term. All right. So
before you close out of that, Chris wanted to know if you could take a look at 2008, 2009 on this chart, just to kind of see
what
happened last time around.
Yeah, we actually looked at that last week. We went further back. So there's a couple times when, in 2008 was one of them, when we dipped below for longer. And I go into detail on that in last Tuesday's session. So as you can see in the housing crisis, the market lost over half of its value in the second half of 2008 due to the housing bubble. So again, this is why it's so important. And I don't want to spend a lot of time on this week because we did this last week. But how to interpret and react to the false breakouts of the 36-month moving average. Because if you see any closes above and then subsequent close back below, that's where we really tend to get more severe sell-offs. So again, if July, let's say we get a strong close above, that might be our signal to go long. And then we get faked out and we get a close in a later month back below. When that happens, we tend to see not only a significant sell-off, but also a longer term bear market from that level. And then we want to wait once that occurs for price to come back up above the 28 period moving average. And when you get to that point, you have a decision to make. Do you take an aggressive stance and trade the actual breakout, or do you wait for a retest of the level? And so we'll talk about that if and when it happens. And I'll kind of give you the way that I do it. But just high level, basically, the longer the market spends and by market I mean S&P 500 index, spends below a 36-month moving average, not only does it indicate we may be out, once it does return above, that we may be out of a bear market, but based on how long it spends below and then closes above and retest, tends to lead to really long bear markets. And that's what happened here in 08. So we spent a significant amount of time below the 36-month moving average. And as we finally get above and retest, it kicked off this decade plus long bull market. So it can create incredible opportunities. But again, review last week's session where I talk a little bit more about how to analyze when the market spends time below the 36-month moving average, what happens when it gives us a false breakout. And I talk a little bit about the sentiment behind the price action around these levels. I want to see very strong conviction behind these. This was not the case in 2008. You can see how little conviction there was. What I mean by that, very narrow range. There wasn't a lot of conviction above these closes. And of course, in May, that was the real warning because that stalled and we didn't really get much of a move above the average. So I like to see this 2019. I like to see this 2020 wide long range candles. And we're setting up for that right now. Again, but we don't have the confirmation yet. And a lot of conviction, wide ranges, a lot of buying from high VIX, high volatility conditions with because this tells me a lot of institutional money's coming into the market to create these ranges and drive prices up from such extreme lows. That doesn't tell me that. This is a pretty feeble attempt, but also does create opportunity. So, yep. And there's actually, if you go back even further, so we're looking at 15 years of data, and if you go back like 20 years, this has really only failed a couple times in the last 20 years, and that was in the dot-com bubble and then the housing bubble, where the 36 period moving average really failed. This could be considered a failure in March, but not quite as much because it was a market crash, not a bear market. And we only spent 1 month on a closing basis below the level. So generally when we start to see subsequent closes below, that's our indicator that things are a lot uglier, to the extreme that are even worse than they were during the dot-com bubble. And we saw 3 years of negative returns on the S&P, or the 2008 housing bubble, where we saw the market lose half of its value in the second half of the year. So that's why we're watching this so closely. Are we going to see another dot-com bubble from late 90s, early 2000s? Are we going to see another housing bubble from 08? Or are we going to see this 36-month moving average mean reversion, service support, and the market rebound from there? Lot to be learned from this and a lot to look at.
All right, let's see. I got a couple votes for gold, GC.
All right. Futures?
Yes.
All right.
3 votes.
3 votes. Wow. All right. So there is strong support on GC right now that I'm keeping an eye on. The strongest level that I'm watching very closely is 1800. And reason being, obviously a lot of support where price moved off of that level. So it's held, but also as gold futures were trading below 1800, was a significant resistance zone as well. And so that's why, 1800 on gold futures is so significant, and really the strongest level that's relatively in play that I'm watching. In terms of price action, we've got a lot of consolidation occurring right now, with strong overhead resistance around 1880. To 1850. So that's kind of our resistance zone on gold futures. And currently we're kind of rotating off of this the lower boundary of this resistance zone, and potentially approaching the lower support zone. But I expect that the lower zone here at 1800 will hold. And if it breaks, then we're watching for a rotation lower into around 1750 to 1760. But we also have some softer support around the kind of the 1785, 1790 level. But we've got some pretty strong support, as well as some strong resistance, and likely while we're seeing this this consolidation for such an extended period of time, it's really been going on since May. So for the last couple of months, we've just been seeing consolidation between this 1800 to roughly 1880 level, and so until we can break one of those, I expect more consolidation, not a lot of directional move. So for something like this, I would situations like this is where I would look at vertical spread strategies, selling out of the money, credit spreads, but not a lot of directional movement. So I would avoid directional strategies, whether it's a directional position on the gold futures or a directional options play like buying calls or puts, or because there's just too much resistance and support, too much support, too much resistance, and too much price consolidation. So these are types of scenarios where I look for vertical credit spread plays and things like that, and I avoid directional plays on the actual futures contracts or options on futures. So
all right, let's see. Jeff wants you to take a look at Ford.
Ford Motor Company.
Yes.
All right. Should just be F, but maybe it's because I have gold or futures. Let's get rid of futures. Oh, that didn't come up for me. All right, so yeah, and Ford's just gotten hammered. I mean, holy cow. I think that. So we had a recent buy on June 24th by warning. This did hit the trigger entry on June 27th. It seems like we might have looked at this one recently, but obviously the shares have just been pummeled this year. They were trading up at 25.87 and seem to be basing around 11. So I think the good news on a technical level, as it relates to Ford, is there's very strong support down here around 11. And you can see that the last time the shares were down around this level, which was over a year ago, we did get some strong positive momentum and upward movement off this level. So it generated buying interest down at these prices in the past, but also different circumstances, right? So interest rates are starting to go up. So we need to think like, how is this going to impact things like not just the obvious ones like buying a home, but also buying a car. Most people don't pay full cash for a car. Most car purchases, new car purchases, are financed to some degree. And so there will be a trickle down effect between, the major automakers, Ford, GM, that is affected by rising interest rates, right? Likely fewer people are going to be buying cars, but then there's another component, and it's gas prices, right? So, one of Ford's, I think, best sellers is the F-150 pickup, right? So when you start looking at these high gas consumption vehicles, that's going to be, difficult to come out of. So on the positive side, there's very strong technical support around 11. On the negative, we got a lot of fundamental barriers. So for me, I really want to, be keeping an eye on technical resistance and and at the same time watching the fundamentals. Our gas price is going to come down, and even keeping an eye on auto rates, and how high they get, and things of that nature. Because we've really got this strong, significant zone from 11 to a little over 12 a share. And even if we do get a rebound, well, I mean, we've gotten the rebound off 11 up into this resistance zone already, and see the rejection happen today, which tells me that, we may see a rotation back into this 11 support, or at least further, trading within this zone. But I want to really start looking for strong closes above 12, and lower gas prices, and stabilizing interest rates, auto rates specifically, before, I start taking the automakers, seriously, and maybe even looking at long positions on them, because right now they're very vulnerable, and likely a lot of the sell-off is taking place, and eventually these are going to be incredible buying opportunities, in my opinion, but it could take some time, and patience. And anytime a good quality company like Ford or GM gets hammered like this, while it creates great buying opportunities, we never know exactly where the bottom might be. And so if I do ever, look at these kind of beaten down quality stocks, or companies, I should say, I really start getting into not just the fundamentals I mentioned, but money management. So, if I'm going to build a position in, a situation like this, like we're looking at with Ford, that's where I'll use things like dollar cost averaging, and really planning out my trade, and determining where I want to potentially get in, and then even looking at incorporating options, throwing options into the mix by using protective puts and things, just in case it gets uglier before it gets better. So kind of a mixed bag on this one, but eventually I think around these price levels, a lot of these stocks are going to become very attractive buys, in a matter of time before they go back up. So
I remember last time around 2008 or something, they went down to like $1 or something. It was super low.
yeah,
Very, very low back then.
yeah. Can you imagine buying Ford at $1? Oh my gosh,
It was crazy.
um
Let's see, got a few more. USO, Chris.
okay. Yeah, so we've seen a rotation higher in oil recently. So this is the United States Oil Fund. And we did close above strong resistance around 82.50 to 83 today, or yesterday and today, really. So yeah, we're watching oil kind of restage a bullish move. I mean, it's had a huge run up this year, of course. I don't expect we're going to continue to see these kind of parabolic moves in oil, but it looks like we're rotating higher, and so for now on USO, I'd be watching 88, just because there was a major sell-off after this parabolic run earlier in the year from that level. We rotated lower off 88 all the way down into like 68. So, and it happened very quickly in just a week or two. So that's going to be a major level to watch as we move up on on a lot of the oil ETFs and stocks and futures and things. 88. So very near term bullish because we're getting back above some of these strong resistance levels, but also I don't expect there to be another huge run up like we've seen so far this year, but likely some strong resistance to encounter here on USO, and then of course if we do break 88, want to be looking at the resistance zone around the highs from late May, early June.
All right, let's see. Can you look at HON?
HON is in Nancy? Honeywell?
Yes.
Yep. All right, so Honeywell's also just been clobbered this year, and let me get this zoomed out a little bit better because I want to really take a look at something here that's interesting. So I'm really zoomed out here. We're looking at over a couple years worth of data, or about a couple years worth of data. So this 175 is really strong support. Okay. So I'm expecting Honeywell to, and watching this level closely, to rotate higher off this level. And you can see some of the past price action and consolidation that happened around here. And if it can hold this support level and rotate higher, we've got room to run into resistance, right? So we're kind of at the bottom now of this channel, and just want to notate that in between that, kind of right around 185, we've got some significant resistance to watch as well. So if we break 185, then because look what happened last time, that 185 level served as resistance, and then price broke through in mid-September. When we can get through that, then the stock tends to make a bigger run up. So my hope and expectation is that Honeywell's kind of bottomed here off this lower part of this channel and strong level of support, and will rotate higher. And then in terms of seasonality, the stock, if we look at around this time last year, we tend to get a move up in the stock around the middle of the year. In 2020, more so, but largely because it sold off so significantly from the COVID crash. So while we tend to get some ranging or sell-offs in early part of the year in terms of seasonality, we often see rebounds in the stock mid to late year. So I'm kind of watching all those things on Honeywell, and then this 175 to 185 zone is really our strong area of support to be keeping an eye on with this stock.
All right, how about PSX for Vicky?
All right, so Phillips, a lot of volatility in the stock. I mean, let me get zoomed in here a little bit more. So big sell-off in May, and we always want to be looking at, when these types of moves occur, are they moving towards or away from a level? They're moving towards it from the top, it's support. If they're moving, away from it to the upside, also support. And then if they're moving into it from the downside, resistance, or away from it from the downside, resistance. So this is the first level that catches my eye and the most relevant near term as it relates to the current price of the stock. Why? Because look at these prior moves off of this level, right? So a lot of them and significant. the stock broke this level last week and then came back up and retested. So remember what happens when, so this was support up until was it Thursday last week, broke through. So when a support level breaks, what happens? It becomes resistance. So we've now traded up into resistance and seen some rejection of that level. Let me zoom in a little bit. So how do I, analyze this? Well, this is to me is bearish because strong level, it's a resistance. We broke it as support, moved up into it and rejected it, right? So now I want to watch to see, do we rotate lower or do we break through and close higher? And once I have the answer to that, then I'd be ready to, make a trading decision, whether it's, bearish or bullish. But right now the picture is bearish as long as that resistance level holds. Let's take one or two more.
All righty. How about Tesla?
All right, looks like we're actually starting to get out of this bearish divergence cloud. I'm going to look at the scanner actually real quick and see. Yeah, we are out of the red divergence cloud. Interesting. And recently got a buy, but we had everything, so many things sold off today with the broader markets. This was no exception. But we're seeing some strong basing around 625. So that's as we rotating lower off resistance, which is closer to the 750, 775 zone. Okay, so again, always ask yourself, where are the levels and what is the security doing from those levels currently? So we're rotating lower off of resistance. That's what's happening right now. So then when that's happening, what's the next question we have to answer? Where are our support levels that we need to keep an eye on? And 675 to 700. I have to look see what the close was today. It looks like it was pretty close to 700, but maybe a little bit below. Yeah, so we closed just below 700. So look at that level from back on February 24th. It was actually the exact low that day. The low was 700 and 700 double O's right there, and then move up off that level. So so we closed below the low here. So my expectation is we see a rotation lower into lower levels of support, 675 and potentially even 625. And then, we'll want to look to see if those levels hold and we see a rotation higher. And then, these levels still remain, right? They just will transition from support to resistance if that occurs, just like these did up here. So yeah, I think that we've got some significant lower levels of support. Biggest one being the 625. Why? Because not only is that held this year, right? So if we look at, so we look at late May, mid-June, but then look back here, around the same time last year, right? Getting into July, we double bottomed around this level, around the same time last year, a little bit later, early mid-July, and saw a huge move where the stock more than doubled in the second half of the year of 2021. So not by any means telling us that that's going to happen now, but that's what I look for when I analyze these levels is what were prior moves from this level. Well, we've seen it hold this year, not as significant moves yet, but also that happened back in July, right? We saw this level hold and move up into these. Look, I actually marked these levels right here based on current price action, and just coincidentally, they coincide with these levels from back in July of last year. So it's if you kind of paint the picture between mid last year and current times around the same time in the year, we saw a very similar price action actually that we're seeing now, and then a big move eventually off this level. So that's promising to me, but as always, I look for confirmation and how price reacted around these levels in the past. So it did take a couple months of ranging and testing some of these levels and breaking through them, and then as resistance and retesting as support. But that's why these levels can be so valuable. Is really you can use these for potential future buying or selling opportunities. And then obviously we got this really nice move up. So this will be a fun one to watch, actually. Let's see if we see similar reaction here. And just in terms of fundamentals, I know there's been supply chain issues and things with Tesla. It's not a stock that I trade or follow closely, but interestingly, I mean, they obviously make electric cars, and gas prices are going up and things. So it will be kind of interesting to see how that impacts the electric vehicle market. In addition to even companies like Ford, and a lot of the major car manufacturers are getting into electric vehicles or hybrids and stuff. So that these names could benefit from high gas prices, and likely why we're seeing some of these base. But I know there's a lot of other fundamental considerations to consider, to take into account with Tesla itself. But obviously a lot of buying. And when you see big moves off a level like this, it takes institutional money to push this up and sustain it. So this tells me that these were likely, funds or institutional buyers that came in off this 625 level. And it looks like, they're trying to do it again. So it'll be interesting to see, through the rest of this year, if we see a bigger move up off these levels and can get, through some of these resistance zones that I've mapped.
Awesome.
No problem. All right. Well, those were all great suggestions and fun ones to look at. So we can go ahead and, wrap up with any remaining questions that may have come through. Richard, if there are any remaining.
Let's see. There's kind of a one. Let's see. Let me find it here. Are there any symbols that can hedge a home value?
Hedge a home value?
Yeah.
I'm not sure what you mean by home value. Do you mean like housing market, like a down housing market, or like home value, like a personal home value?
Let's see. This is Ed asking. Let me see.
Maybe Ed, if you can let us know. I think there might be some ETFs out there that are like inverse REITs or like inverse. I'm pretty sure. I'm not real familiar with any off the top of my head. I'd have to do research a little bit. But I'm sure, the cliche is there's an ETF for everything. I'm sure there are probably some inverse ETFs that, inversely track the housing market or home prices. I'm just not really certain any names, but we could look into that. That's a good question.
Yeah.
Yeah, Ed, if you're on next week, remind me. I'm going to look into that before our session next Tuesday. Mainly, what I'd be looking for is like inverse ETFs, or REITs are usually a REIT is a real estate investment trust. Tend to get hit harder during housing downturns, and maybe would research if there are any like inverse ETFs for REITs or inverse housing ETFs. I'm sure there are probably some out there. Yeah.
All right. That's what I got.
All right. Well, thanks everybody for joining this week. Great to have you. Great questions. Thanks for all the participation and the suggestions for stocks to look at. We'll hold our next session next week at the same time and same place. Watch the close on Thursday on the S&P very closely as it relates to that 36-month moving average. And we're going to follow up with that again next week, because we'll be into the start of July next week. So keep a close eye, and we'll follow up on that next week. I hope you guys have a great rest of the trading week. Is next weekend 4th of July? I think it is. Yep. So hope you guys have a happy 4th, which I think is on Monday. And we'll see you the next day, Tuesday, for our next weekly session.